Hare Krishna. Once again, welcome to my channel, Purposeful Prosperity. We are continuing with our wisdom series from the Little Book of Common Sense Investing, and today we are going to go to the chapter 20, which is the last chapter of this book, which says that investment advice that meets the test of time, and where we are going to see how the Benjamin Franklin's principles are applying even on the investing, which are time tested. So Bogle is beginning the chapter which says that to repeat with such an index-driven strategy may not be the best investment strategy ever devised. The number of investment strategy that are worse is infinite. So that's something really important for us to note. That so here we need to understand that Bogle is not saying that index investing is the best investing, but he's saying that there are many investing style which can really hamper your investment journey, and all those can be avoided completely by being in an index driven strategy. So let's just say a similar kind of quote I found from the Warren Buffett, where the Warren Buffett says that the rule number one is never lose money, and the rule number two is never forget rule number one. So if you say the investing, which is being prescribed by the Bogle, it is quite matching with whatever Warren Buffett is saying, which is about never lose money. So there are many investment style where we might be losing compared to the market returns, so we should not be going on those strategy. In fact, we should be sticking with the index fund strategy. Warren Buffett further says that most investors, both institutional and individual, will find that the best way to own the common stocks is through an index fund, which charges the minimum fees. Those following this path are sure to beat the net result after their fees and expenses, which we term as cost, of the great majority of investment professionals. Yes. So, investing guru Warren Buffett is saying that if you stick to an index fund, a low cost index fund, then in a long run, you are going to beat the most investment professionals. Isn't it a wiseful advice? And don't you think it's going to match with whatever Warren Buffett is saying previously? With the I think Warren Buffett's and the Bogle's thinking are matching here. So this shows that these are time-tested principles. Then Bogle further says that for all the inevitable uncertainty amidst the eternally dense fog surrounding the world of investing, there remains much that we do know. So every great investor, we should be humble enough to know that there are many things which are happening around the world, and we have very little knowledge about those things. If somebody who is saying that he can really predict the markets, then I would say either he is a god or he is simply making a fool of you. So we should not be listening to those things. In fact, look at these great investors. They are how they are humble. They clearly says that we don't know what the future has for us. Then some of the common sense realities Bogle is mentioning. So first of all, he's mentioned that that we must start to invest at the earliest possible moment and continue to put money away regularly from them on. So we need to really understand that the compounding principle works better the earlier you start. If time is in your favor, then everything is in your favor. Then second thing he says that we know that investing entail risk, but we also know that not investing dooms us to financial failures. So that's also very important. So we really understand that we cannot guarantee that the index investing is going to give us the best returns. But we also know that if we don't invest, then also we will be having a financial failure. So we know the sources of return in the stocks and bond market, and that's beginning of wisdom. So I think in the beginning of a couple of the chapters in this books, Bogle has clearly given us that how the stocks and bond markets are getting the returns. And so these are companies which are paying dividends and they're earning growth. And bond markets returns are completely linked with the interest rate which are prevailing at that point of time. So knowing about all these things, basic things, you are making yourself as a wise investor. We know that risk of selecting the individual securities. We also know the risk of selecting the fund manager or the risk of selecting different investment styles. So different kind of risk are there, and all those risks can be avoided using the index fund. So Bogle says that they can be eliminated by the total diversification offered by the traditional index fund. Only your market risk remains. So you are investing in an equipment where only market risk remains and all other risks are ignored. That's very important. Then Bogle continuing and says that the we also know that the cost matters and it is overpowering in the long run. So we must try to minimize this as soon as possible, as much as we can. We know that taxes also matter. We know that the short-term taxes, the long-term capital gain taxes. So all those taxes also we should try to see that we are investing in an equipment where all those things can be avoided. Then the last point he says that we know that neither beating the market nor successful timing the market can be generalized without self contradiction. So we have to really understand that there is no proper way of beating the market. There is no science of timing the market. So if somebody is saying these things, then they are contradicting the basic mathematical principles. So these are the common sense realities which Bogle has given us a good understanding in each of his chapters. So common sense is the really important. And I always say is that we have the five senses, but out of the five senses, the most important is the sixth one, which is the common sense. So in one of the quote, it is being said that common sense is a genius dressed in its working clothes. So we have to really understand the importance of the common sense. Then Bogle finally ends with all these common realities and say that finally we know what we do not know. We can never be certain how the world will look tomorrow, and we know far less about how it will look a decade hence. But with intelligent asset allocation and sensible investment choices, we can be prepared for the inevitable bumps along the roads and should glide right through them. So that's very important. So Bogle is completely accepting with his humbleness says that we don't know how the tomorrow is going to be. But if you know, if you have a proper intelligent asset allocation, I think the previous chapters, two chapters were completely focused on that point only. And if you have a proper asset allocation with some sensible investment choices, then definitely you are prepared for that future for which we don't know about much. Then Bogle is saying that the earning our fair share of return, whatever returns our business enterprises are generous enough to provide in the years to come, that to me is the definition of investment success. See, investment success is not that I can beat the market or I can generate some 20, 30, 40%. No, a common sense clearly says in terms of Bogle that if you want to say that you have an investment success, then if you are able to get whatever your all the corporate enterprises of your country is providing you in terms of a fair share of your market return, if you can get that market return at a low cost, that means that you are a successful investor. So that's the definition of an investment success. So later in the chapter, Benjamin Bogle is trying to compare some of his principle with Benjamin Franklin, who is also one of the great philosophers we have. So let's just see how both of them, their basic principle keys are going to remain the same. Let's just begin. So on saving for the future, the Franklin says that if you would be wealthy, think of saving as well as getting. So just the saving is not important. We need to also focus on our earnings. Remember that time is money. Lost time is never found again. So time is the most precious thing. Even a most richest man who is on his deathbed, he can spend millions of dollars, but he can never get that one moment in his life back. It's not possible. Similarly, Bogle says that not investing in the surefire way to fail to accumulate the wealth necessary to ensure a sound financial future. So if you are not investing properly, then definitely you are not going to meet your financial goals. So that's also very important. Compound interest, we understand that that's a miracle. And in order to compound interest to work, we need time. So time is your friend. for your compound interest to work. So give yourself all the time that you possibly can. You see, both of them are telling two different things, but the basic principle here remain the same. Second, on the point that on the importance of cost control, where Franklin says that beware of little expenses. A small leak with, will sink a great ship. Similarly, we understand that in the investment world also, Bogle says that the basic arithmetic works. Your net return is simply the gross return of your investment portfolio minus the cost you incur. So if you can minimize the cost or investment expenses, so that should be the right way to do it. So although this cost look very small in the beginning, but then this cost also get compounded, and this can sink a great ship of your investment journey. Then on taking risk, Franklin says that there there are no gains without pains. He that thought he that would catch fish must venture his bait. So we have to understand that if you have to gain something, we have to take some pain also. And if you talk in terms of market, then we understand that market volatility is that pain. And if we go through that market volatility or the market cycles, then there is a huge gain waiting for us to get. That's why Bogle says that we must invest. So the biggest risk is the long-term risk of not putting your money at work at a generous return, not the short-term risk of market volatility. So Bogle also says that market volatility is not the risk. In fact, the biggest risk is that inflation is eating all your earnings. Your money, which is kept idle, not put into proper investment, then it is getting duplicated on a day-to-day basis. So that's very important that we must invest. Then on understanding what's important, the Franklin says that investment in knowledge always pay the best interest. So definitely the knowledge investment is the best thing, and that's what we are trying to do through this channel. I myself found this book to be very useful, having a lot of knowledge for a retail investor, and I'm trying to spread the same thing through my videos. And all of you guys can share these videos and share and this share this useful knowledge among all the retail investors for their best interest. Then learning is to studious and riches to the careful. That's also very important. So with all these learnings, you can become studious. But if you are careful with those learnings, you can become rich also. If a man empties his purse into his head, no man can take it away from him. So we know that once that knowledge is be there with you. So knowledge is that treasure which nobody can take from you. So please invest in getting more and more knowledgeable. That's what we want to become our investor, our community members to be a wise invest investment retail investor. Bogle also says that to be successful investor, you must need information. And he also says that if information about the past return earned by the mutual fund is close to meaningless, but the information about the risk and the cost is definitely priceless. So we really need to filter out from the information available. We need to extract the information into our knowledge and then use that knowledge for in order to make us rich. Then on the markets, Franklin says that one man may be more cunning than others, but not more cunning than everybody else. And if you look at the investment people, I think every investor think that okay, I have a plan, I have designed a portfolio through which I am going to beat the market, which no other retail investor can do. But unfortunately, he himself is wrong. He himself will not be able to beat the market, and he whatever plans he is thinking that only he knows. Unfortunately, everybody knows, and millions of investors knows about that thing. So that's why Bogle says that don't think that you know more than the market. No one does, and don't act on insight that you think. are your own but are usually shared by millions of others. I see many people watch these investment channels, they try to extract some news, but all these news has been shown to you because that news has already reached to the investment advisors or the mutual fund owners or the big investors. So that news is also being dumping on the common retail investor, and they are getting fooled by those watching these kind of channels or going to some of these newspapers about these business news and all those things. So don't waste your time on that because nobody knows more than the market. Then on the safety, Franklin says that great estates may venture more, but little boats should keep near the shore. So we have to really understand that if you are a big investor, definitely you can take more risk. But if you are a small retail investor, you need to make sure that we are really cautious about where we are investing because we have to follow the Warren Buffett rule that never lose money. A retail investor cannot afford the mistake to lose the money. That's our important rule number one, and that's something we should be keeping on our investment desk to make sure that every day we remind these things. There will be so many advertisement done by the different fund industry series channels, the TVs, the newspaper. We need to, if we have that rule number one, never lose money, then that single rule is going to save you from all that uh, wasteful information that is being dumped on the retail investors. So Bogle says on the safety that whatever your assets are great or humble, diversify, diversify, diversify. So diversify is the simplest answer in a portfolio of stocks and bond. And then you have only the market risk, which is going to be with you for your portfolio. So investor of modest mean should be especially cautious. So he also gives the warning. So Bogle also clearly says that if you're a small retail investor, then we should be really very cautious with our investments. Then on forecasting, so where Franklin says that it's easy to see, but it's hard to foresee. And similarly, line the Bogle says that it takes wisdom to know what you do not know. That's very important. I think all these different mythologies of investment styles, they are trying to predict that you know everything. And that's why you are able to design a best possible portfolio. But here, both the great personalities are saying that it's easy to say that you know everything, but it's really hard and really not possible that you know everything. It's not simply not possible. Similarly, on looking after your own interest, Franklin says that if you would have a faithful servant, then serve yourself. And on similar line, the Bogle says that you must never ignore your own economic interest. So we have to understand that that AUM industry is being developed for their own interest. We have this financial planner, financial influencer. We need to see that are they looking for your interest or are they looking their own interest? As a retail intelligent investor, we should always look for our own interest. We need to make sure that we are not misguided by these false claiming financial influencer who are trying to influence different peoples. We should be not doing that thing. And we also know that the humble arithmetic rule says about reversion to mean. We also understand about the cost implications. So definitely all those things are beneficial to the industry, not to us. So that's something we have to always understand. Then on set fitness, Franklin says that the industry perseverance, frugality makes fortune yields. So that's very important. On and similar line, the Bogle says that no matter what happens, stick to your program, think long term, patience and consistency are the most valuable asset for the intelligent investor. So stay the course. I think all the big industry of this finance thing, they always say that always do something. They always make all these channels, advisors, and all those what they are doing. They are making you impatient. They make sure that you trade something, you buy something, you sell something. That is what they are igniting. But here we know that both Franklin and Bogle says that this patience and perseverance is the key. We need to always plan for the long term, and we need to stick with that no matter what happens, because we have to understand that index investing works, just that we have to have that patience and consistency. Then Bogle, continuing on this, Bogle says that our near parallel maximus suggests that the principle of sensible saving and investment are time tested, perhaps even eternal. So that is something we have to really understand. So finally, he is concluding that we should always work on those principles which are sensible and which are time tested. There are many philosophies which comes for a few years, they works for a couple of years, and then that suddenly we feel that okay, that philosophy is gone. We don't want to do our investment journey, which is a long term investment journey of 30, 40, 50 years. We don't want to have such kind of principles imbibe in our investment journey. We want to imbibe the principle of investment which are time tested, and these and the whatever Bogle or the Warren Buffett are suggesting, those are the principles which are time tested and eternal in investing. So what is the way to wealth? So on this, Bogle is saying that to capitalize on the magic of long-term compounding of returns, but to avoid the tyranny of long-term compounding of cost. So we really have to understand that this long-term compounding works. We have to give good enough time for our returns to compound. But at the same time, our investment should be in a low-cost vehicle, because these costs are also going to compound in the long term, and it can really destroy your wealth. Second point on the way to wealth is avoid the high cost, high turnover, opportunistic marketing modalities that characterize today's financial service system. So I think today's financial world is working on based on this advertising, where different kind of funds, thematic funds, algo trading. I think that you name them and you have everything available in the market just to make you fool, just to extract from additional cost from you, have some high turnover cost and all those things. And at the end, all of them are going to destroy or then make some dents in your investment journey. On the third point, Bogle says that while the interest of Wall Street business are well served by the aphorism, don't just stand there, do something. If you look at all these channels, they start morning at 7:30, and if you look at every half an hour, every 10 minutes, they have some different kind of people. One person is saying that okay, you buy this stock, have this stop loss, sell at this point. What they are trying to do, if a person is watching these kind of channels, let's say for 1 to 2 hours, you are definitely forced to do something. Let's say even if you have holding one stock, okay, one advisor is saying okay, this is a good time to exit from the stock. After next day you see another investment advisor come, it says okay, this is a good time to enter. So they keep on doing this kind of a thing, that don't just stand there, do something. But Bogle has clearly says that the interest of investors are well served by an approach that is it's diametrically opposite, which is don't do something, just stand there. So if you simply buy a low cost index fund, then we need to simply hold that index fund forever, and that's what we need to do, nothing else. Uh, then Mr. Cliff is also giving some nice quotes around this thing, where he says that a very nice analogy he has produced, where he says that we basically knows how to invest. So a good analogy is to dieting and diet books. So we all know how to lose weight and get in a better shape. That simply eat less and exercise more. So that's simple, but it is not easy. So investing is also no different. So definitely we know that we have to buy a low cost index fund and hold it forever. So that's pretty easy, but then nobody is able to do that thing. And why? Why? Because we are missing the knowledge behind that. That why we need to do this thing. And I think this book is providing you enough information, enough data, enough knowledge about all these different aspects so that you can really convince that this works. So investing also works. Investing in a low cost index fund is the best way to get your fair share of return. This is pretty simple. It's very easy to do it. You just need to believe it. And if and by reading these kind of a great investor, we are making our belief strong. And that's the way to do if we want to really do this thing, if you want to really play this game for a very long duration. Then Mr. Cliff further says that some simple but not easy advices for good investing and financial planning in general includes uh, diversify widely, keep costs low, rebalance in a disciplined fashion, spend less, save more, make less heroic assumption about future returns. So you look at all these points can be achieved by simply investing in a low cost index fund because it is widely diversified. A low cost index fund is having its cost law, and if you are having a proper asset allocation, then you can do the rebalancing of those index fund in between your stocks and bond in a disciplined manner. Then you are spending less, you are living a life of a frugality, you are trying to save more, and you are not making any heroic assumption about the future return. You are not trying to beat the market. So all those things, whatever Mr. Cliff is saying, all those things can be summarized in a low cost index fund. At the same time, he also gives us a warning where he says that when something sounds like a free lunch, assume that it is not free unless you are convincingly arguments are made, and then check again. So there is no free money. That's something we have to really understand. If you see on the YouTube itself, there are many advertisement coming where they are saying that you give them 1 hour and they can make crores to you. They can make you a full-time trader. There are many channels which are simply giving some tips. Okay, you buy this share, you buy that commodity, or you buy this thing, you buy this option, or this future. What they are doing all these things, so we have to understand that they are not there to serve you free lunches. They cannot. So a retail investor should be simply avoiding all that noises and only stick with a low cost index fund. So Mr. Cliff, in his last statement, he says that stop watching the stock markets. And I would also add that stop watching the news channels also, especially the channels which are based on the stock markets. Work less on investing, not more. Look at his second advice. He want investing to be very simple, simplified. We should not be working on our investment portfolio on a daily basis. I think most of the retail investors watch their portfolio 2 to 3 times in a day. We don't want investing like this. We want work to be less. Let's say if you want to rebalance once or twice in a month, then I think that's what you need to know. Even once in 3 months or once in a 6 months, if you see, that's also good enough. We want to work less on our investment. We want to work more in acquiring the knowledge. So in true hypocritic fashion, do not harm. Do not need, you do not need a magic bullet. Little can change the fact that current expected return on a broad set of asset classes are low versus history. So he is also giving us a warning that we cannot go by the past return. We have to understand that the in future returns might be low, whether be it's a bond market or be it a stock fund. So definitely we cannot, we don't need any magic kind of a mutual fund for us. A simple low cost index fund should be good enough for us where we are going to make some realistic expectation. So that's why he says that stick to the basics with discipline. That's very important. And that discipline we are going to get once you have a firm knowledge about what you are doing. And by reading these kind of a books, we are trying to get that knowledge and make ourselves disciplined investor. A disciplined investor can only ride the market for a very long time. Otherwise, nobody can do that. They see some 10, 15, 20% return and they simply sell up everything and they book those profits. And later on, when they try to enter the market, they suddenly feel that the market is too costly, or they try to enter the market very slowly. And that's where they are simply breaking their compounding logic, which is working on their investment portfolio. So discipline is a must for a good investor. Then Mr. Paul Sampson uh, again puts a very strong statement. He says that the creation of the index fund by John Bogle was the equivalent of the invention of the wheel, the alphabet, and wine and cheese. So you look at these things. He says that these essentials of our existence that we have come to take for granted have stood the test of time. So will the traditional index fund. So he is also saying that the traditional index fund is time tested. Its principles are time tested and eternal. And he, in fact, comparing the index fund with the invention of wheel, which is considered to be the most important, or the alphabets. These inventions are considered to be the very great for the humanity, although we don't consider them as great because we are pretty used to of all these things. But these are great invention, and this is being compared with the index fund. So that clearly shows that index fund also is a very great invention, and retail investor should stick to this time tested invention done by the John Bogle, which is about the index fund. That's what the advice Mr. Paul Sampson is trying to give to us. Bogle, in one of his Warren Buffett, in one of his quote, clearly says that by periodically investing in an index fund, the know nothing investor can actually outperform most investment professionals. See, a know nothing investor can actually perform good. Then why are we not doing this thing? We are trying to beat the market in so many different philosophies or different kind of portfolios and all those things, but he clearly says that by simply owning a stock fund, index fund, you can actually beat all the investment professionals. Then why don't we listen to Mr. Warren Buffett? Why don't we listen to John Bogle? Why we? Because we still feel that I can beat the market. And Bogle has already said that that's a loser's game. We all are trying to play a loser's game and want to make sure that we are going to become the winners. But unfortunately, we will become the losers. So, guys, please don't make the mistake and start your code portfolio with most of the percentage in an index fund. Now, you might be asking, okay, what percentage should I have of index fund in my core portfolio? So, let's just hear what Mr. Charles has to say. So he says that most of the mutual fund investment I have are index fund, which are approximately 75%. See, such a great investor, he openly says that 75% of his core portfolio is into index fund. But we are the one who still think that the active mutual funds are going to beat these indexes and they are going to perform good. I am going to beat the market and I am get some 15% return, 20% return. Unfortunately, we are not going to get anything out of that thing, and we will be really cheated by all these advertisement done by these financial industries. Then Mr. Jonathan says that I am a huge fan of index fund. They are the investor's best friend and the Wall Street's worst nightmare. So look at his line. He says three times, huge. When you say one time, it's important. Two times, it says more important. Three times, it says more, very critically important thing. So index fund are critically important for a retail investor. And we need to really listen to all these great personalities. All of them are really convincing us, giving us enough proof, information with their past experiences of investment journey for such a long time. We don't have that long. We are not going to live that long so that we can learn those investment mistakes by ourselves. An intelligent person is one who is learning from others' mistake and who is making himself wise by other people's knowledge. That is what we need to do. So please listen to these great investors and make sure that you invest in an index fund. I would really advise all my viewers to please go through this full list of chapters. I have created a playlist of 20 chapters. Please go through this once again. You will really get to learn a lot. And at any point of time, your belief is being shaken on an index fund. I would highly encourage you to go through this playlist, and I'm sure you can. That playlist alone can save you from making any kind of blunder or mistakes in your investment journey. So I hope by now will be really convinced that investing in an index fund is really a time-tested process for a retail investor to get the fair share of market return, which all the citizens really deserve in their investment journey. So thank you for staying with me. I hope you get something out of these sessions which I have been conducting, and all of them are making you some more wiseful retail investor by providing you the required informations and tools, logics, and the quotes from the great personalities are really making you a disciplined retail investor. If you think this kind of a contents are really helped you and really make you wise and are giving you some valuable knowledge, then feel free to please share this kind of content to more and more retail investor so that they can also become wise. Let them give the opportunity to get this knowledge, because sharing the knowledge is the best form of caring that you can do for anybody. So please share these videos more and more so they can reach. If you can like these kind of videos, that's also really great, because YouTube algorithms are going to use this kind of a likes to promote these kind of contents to more and more viewers. So this ends the little book of commons and investing. We are going to soon start with the new book. If any of you have like to guess what is the next book that we are planning to have, then feel free to comment, and let's just see uh, who of my viewers are going to guess the next book which I am planning to take. So till then, thank you once again. Hare Krishna.